That's the cheering to start our webinar today, May 18th, 2016. We'd like to welcome everybody aboard. Our main captain, John Randall, is on a sabbatical today. I think he's leading a workshop somewhere on the eastern seaboard at an undisclosed location. And I'm glad to be joined today with our special guest, Lynn Davidson from Charlotte, North Carolina. We'll get to Lynn's case, but first we'll open it up with kind of a review of where we are since our last call. We had enjoyed a pretty remarkable unfettered run really from early February to probably the end of April. May has started off with a little bit of headwinds. Depending on the day of the week, it's either Donald Trump talking about renegotiating the national debt or fears that interest rates might be going up surprisingly. And looks like today with the release of the minutes of the April Federal Reserve meeting, it appears the Fed is really trying to stack the deck to put a interest rate increase back on the table, for lack of a better word. And that may or may not happen, but I would say probably after the day, the futures might indicate it's maybe a little bit better than a 50-50 proposition that might happen. What we'll discuss kind of on the front end is where we are with the market in general. And I think, Grant, are we sharing the screen, the Bloomberg? That is the S&P trailing 12 index on the MACD. You can see we keep getting a lot of resistance and are unable to sustain a breakout to the upside. We're still firmly above the 200-day moving average there on the S&P 500. And it looks like we may be getting a little bit of a kind of rotational leadership change. Financials have performed stronger, as you might expect, finally, with some thoughts that we might be getting an interest rate increase sometime maybe this summer. Some of the former leadership position in the market has taken a little bit of a breather. That would include, but not be limited to, tech. We've got, looking here on my sheet, worst performers in the S&P 500 year to date have been financials as a sector. Tech has been kind of right behind them, as well as healthcare. Those were all big-time healthcare, especially tailwinds last year. If your clients have weightings in the biotech sector, you've probably taken a little bit of a blow to the head, you feel like, this year. And if you're in more of an indexed approach, you've seen a pretty flat year, and we've seen, I think as of this morning, the S&P 500 was up 0.2% for the year, NASDAQ down about 6%. So if you've been in more of a passive approach to investing this year, you probably had some returns that may not be what you anticipated. On the NASDAQ, it's very interesting to note that the last year's darling trade was the FANG, the Facebook, Amazon, Netflix, and Google. Amazon is kind of back where it was. I think it went out today right under $700 a share. Facebook has advanced this year, but Netflix and Google not so much. The other big tech titan on its 26 moving period chart, we're going to pull up here. For 12 months, you're talking about a move from the 130s down to 90, 89 and change, and then back up lately. It's been reported Warren Buffett has kind of put in some money on Apple. It's funny, you talk to clients want to invest like Buffett, but, their definition of long-term and his definition of long-term might be two different definitions. So a conversation we're having with clients is they, depending on how they're invested, if they are invested in a lot of kind of large cap funds or indexes that don't do a lot of changing around, more than likely their performance is probably a little bit down this year. A big reason for that is look at the top of the holdings. If it's a lot of Apple and Google in some of the healthcare names that did well last year, it is not surprising that clients are facing headwinds. Depending on if it's a competitive situation or not, you might want to discuss with them something a little bit more active as an alternative to this strategy. Also, we've seen so far year to date, I've got a hedge fund printout right here. Probably can't zoom in on it, but it's showing that hedge fund performance has really been abysmal. January and February were some of the two worst months on record. There again, a lot of those same names that I said are problems with some of the mutual funds have been problems in the hedge fund universe as well. So what does this mean and kind of where are we going? We have been building probably bigger positions in defense stocks. That would be not defensive, but defense. Clients want to talk about the election. They want information on the election, and it appears, as kind of backed up by maybe the IRG group, that no matter who wins the presidential race, more money will probably be spent on defense than what is being spent now. Obama has really kind of not spent a lot on military, so that resonates with a lot of clients. They understand that. But really kind of the underlying opportunity here, we think, is the ability for Europe to start taking more responsibility for its common defense. I think that may also be a theme coming out of this election. The non-U.S. NATO countries have about 200 million more people than we do, and their GDP is quite larger than the U.S. So it makes perfect sense that we start asking them to pick up more of the load. Along those lines, you've seen anecdotal budget requests go in, especially on the Eastern European periphery and Northern Europe that border some of the old Soviet states as well as the Baltic Sea. More and more spending. Last week, Denmark said they're going to spend about $3.2 billion buying jet fighters to help shore up their defenses. So defense is an area we've kind of waded into here since our last call. Also, another area has been financials. We purchased Citigroup in one of our portfolios, and with the thought that more than likely, kind of like the defense story, whoever wins the presidency will probably lighten up on some of the regulations facing bigger banks in general. Other areas that we've seen probably had the most questions about have been healthcare. And as I said earlier on top of the call, healthcare, as of this morning, was down about 3% year to date as a subsector in the S&P 500. That's a sector of the economy that has political risk written all over it. And depending if you're playing the insurers, the big pharma, or biotech, you've had your losses kind of go up the chain depending on where you are there. So it's not uncommon that clients would get asked lots of questions. As we move forward, I let clients know there's probably, in the near term, there's 3 dates to be wary of. Early, mid-June, we have a Federal Reserve meeting. That will cause some market indigestion, perhaps. June 23rd is the Brexit vote, the day Great Britain decides if they're going to stay in the European Union or not. And our thought there is that's a situation that probably has little upside, maybe some more downside risk there if they leave. And then finally, in July, we have the Republican National Convention. I'm trying to get D2 to budget in a trip to Cleveland for us on that so we can come to you live from the floor of Quicken Loans Arena, but we'll see what happens there. On the alternative side, we've come out of our unleaded gasoline trade. Grant, we did pretty well. Unleaded gasoline dropped back and then has since kind of repeated an uptrend. So people that were late to the game, we're probably looking at 29.11 was the high today. You can see on the screen right here, we're looking maybe to punch out probably closer to $30 with everybody we have left. That's been a pretty good trade. What we're looking at next is gold. The old GLD in the alternative space. The chart was looking stronger. Gold was down a little bit today, mainly on dollar strength. I think when the word hit that the Federal Reserve minutes indicated we're trying to, go towards a tightening. The dollar got hit. So if gold really slides on this chart on our discretionary accounts, we'll probably take that cash that came out of the unleaded gasoline trade and buy a little bit of gold in the alternative space. The other alternatives that we've seen really good results in, and they hit a high last week, I'll put Welltower in here, is REITs. Not surprisingly, big sell-off today. We may have missed an opportunity to kind of get out of those altogether last week, but they've had huge run-ups, and with a fear that rates are going to go up, we've had a corresponding sell-off there in the real estate space. REITs have performed very, very well this year with probably some of the better performance in our models coming from the REIT space. Joyce asked a question, I think, define a little bit of gold. Typically, we're looking at probably 2 to 5%, depending on what the risk level is in the portfolios and what other holdings clients have. In our mega model, we had ABX is, what's the name of that company? Barrick Gold, it's up 149% year to date before today. That's had a huge move off the bottom. So probably 2.5 to 5%, Joyce, to answer your question there. Final thing we'll kind of discuss is fixed income. The same tailwind helping REITs, help fixed income. We saw pretty decent negative moves today. Let's see, the mortgage fund we use, JLS, was down about 2/3%. BBN was down about 3%. MBB down about 2.5%, and BTT down about 1%. So depending on which product you're using, you probably had a little bit of a losing day in the fixed income space, which if you're using it as a true diversifier, that's probably not a bad thing. That's been a tailwind the whole time with us. And I think what we're going to get into is a determination of how much rates will go up and when they do go up, because this has been kind of a one-way trade for a while. And keep in mind, we kind of had some of this hit earlier in the year when there was worries about rates going up. We were able to kind of shake it off as it looked like rates weren't going to go up as much as they thought. The news indicated, the Federal Reserve is saying they have kind of a three-legged stool: unemployment, economic growth, and an eye to what's going on in the rest of the world. Even if they raise rates, our contention is, it will be ultimately very difficult to keep our rates very much untethered from the rest of the world. What I'm pointing to here is, the Swiss franc 3-month LIBOR is negative 73 basis points. You got Japan, you've got the euro, so you've got some bigger counterparties negative. And look at our 10-year government bond rate at 1.769 versus the rest of the planet. So it's going to be hard for us to get too much separation from the rest of the world. So we may have a little bit more volatility. It appears the tech-heavy NASDAQ likes the thought of higher interest rates probably more than the Dow does. S&P pretty much flat for the day. We'll kind of see how the rest of the world digests the situation. As a final thought, we did run up close to 49 and change on oil today before it reversed. So I think another big factor will be, does oil get over the $50 hurdle? And if so, when? Keep in mind the bottom for West Texas crude was about 26 and change early in the year, so it's made almost the double off the bottom. So we'll keep watching that. Everything that I read indicates maybe the Saudis are in big trouble financially a year ago, so I would think they're very motivated for oil prices to get back to, higher's better. I don't know that we'll be back to 100, but I think they have a great deal of motivation for us to have higher oil prices. with that said, what we will do now, I'm going to turn over to Lynn Davidson. Lynn is a 22-year veteran. Grant, we pull up kind of some stuff for her. 22-year veteran with Ameriprise. She's been a PWA advisor since it has started. And so, Lynn, I'm in the same boat, and I don't even know when that was, when that started.
I don't remember either.
She is from the great city and state of Charlotte, North Carolina. And what we're going to kind of go through today is a case from what I call the beginning all the way to the end. So we're going to go from the literally germination stage to the harvest. So, Lynn, give us a little bit of background on your client and the discussions that kind of started on the estate planning exemptions in a very kind of non-threatening, unassuming way, and how you brought him on board to the Davidson practice.
Okay, thanks, Drew. This particular client was my sister's boss. He had a small company, relatively small company, about worth about 20-some million. And from time to time, my sister introduced me to him, and from time to time they would have events down in Atlanta, like golf tournaments and things, as a part of their marketing, and he would invite me to go down there and play golf with him and his team. So I got to know him, gosh, it's probably been 5 or 6 or maybe even more years ago, just on the golf course and having dinner, and just really enjoyed getting to know him. And in the course of our conversations, he would share with me a few little things here and there. And as most people know, with a small business like that, all 3 of his children were involved in the business. Son-in-law's involved in the business, grandson, that type of thing. So lots of complexity. And he was a widower. So when I found that out, of course, the first thing I thought of is, wonder if they were able to use that exemption, which they had not been able to do on the unified credit. So we started talking a little bit about his estate plans, and I discovered that his estate planning was very, very simple, didn't have a lot to it.
So very good. So Lynn, how did you take the kind of meeting him on the golf course, seeing him at some work events, to the next level, and then who did you get involved on the estate planning side as well?
Yeah, I had some conversations with him, just mostly asking some questions and got him, just let him know that I had some major concerns for him with regard to the potential estate taxes if he were to pass away before getting the business sold. And I explained to him about the exemption amounts and the unified credits and gifting, and I just suggested that his heirs would have a real problem because they just didn't have a lot of liquidity. He literally had everything in either real estate or in that business. So we started talking about that. He introduced me to his business broker when he started getting interested in selling the business, and the business broker and I talked a couple of times about some of my concerns about the estate, and between my conversations with the client and the business broker's conversations with the client, he decided to hire me and to do some financial planning work, and then I started talking to the people at corporate office in the advanced strategies group, I think David Houston specifically, about his case, and kind of off we went.
So you get with a business broker, your client gets, I guess, an offer on the table, and walk us through kind of working with the back office advanced team on how they helped you, how you started looking at the client's needs, and then where you'd be kind of placing the business within kind of your quiver of options here at Ameriprise. Okay.
In my discussions with David Houston he's a JD up in corporate office with the advanced advice strategies. Anyway, we kind of determined, after I did some a financial plan. I did a financial plan for the client, and we determined that roughly the estate tax issue that he would have was probably in the neighborhood of about $6 million. And again, because they at the time he didn't have much liquidity, I think that spurred him to actually do a little bit more work with an estate planning attorney, whom I referred him to. So between the business broker and myself trying to help him understand some of the concepts of the tax implications of the estate issues and also some of the capital gains that he was looking at for the sale of the business, he got on board, and then we started talking about, all right, when you sell that practice, when you sell that business, what are your needs? What do you need to have happen with regard to income and, paying off debt? He still had a couple of mortgages to pay down and those types of things. And then I started working with the folks at the wealth management group at corporate.
Okay, so they put together, and working with your client, talk about a little bit about his income needs or lack thereof and kind of how you came to the portfolio that you ended up putting in place.
Okay. The client still owns the business building that the business is run out of. So he sold the business last year, but still has the lease on that business as his income stream. The business is in an LLC, or the building is in the LLC, so he gets an income stream from the lease on that, which was about $20,000 a month. So when we started talking about how much money did he want to invest, he started out with, he said, well, I tell you what, I'd like to invest about $5 million, and, but this is not money that I need for my income because I have the lease income coming in every month. And so we started talking about his account here as being his legacy money that was going to pass to his heirs. So we weren't quite as concerned about driving income for him as we were getting some assets out of his estate. So he did $70,000 each into 529 plans for his great-grandchildren. We wanted to take advantage of that 5-year, I forget what the concept is called, but it's kind of an escalation of the gifting where you can put, 14,000 times 5, 70,000 into those 529 plans and get it out of his estate. And then he was very, very interested in municipal bonds because he knew he was going to have some tax issues. So the folks at Wealth Management Services put together a bond ladder, and we did some select separate accounts with a overall moderate portfolio, about 50-50.
Well, one of the questions we've had come in from Edward Ness is, how did the conversation go to determine the need for financial planning, and how did you determine what you were going to charge him? How did that all happen before, in the beginning of the relationship?
Right. Well, when I started talking to the client about the potential estate taxes and having some ideas about how he might be able to avoid some of that, I explained to him, literally what I did, for my clients, how I worked with clients, and how I charged my fees. I told him at the time, because at the time we started working together, he didn't have assets to invest. It was literally, he had the business, and I just felt like he needed some overall financial planning. So we started on that vein to begin with, and I charged him, I think it was like $3,500 annual fee, just to get his net worth stuff together and start making some recommendations about concepts that he might utilize to reduce some of the estate taxes, that type of thing. Okay.
So kind of going through the big picture with him and then kind of work on building that relationship on an ongoing basis.
Correct.
So you work with our back office. He decided he's got $5 million here. Tell us a little bit about, I guess, the competitive environment you're in too, because Charlotte's kind of a big city, but also word gets out everywhere. When somebody gets $20 million, it's probably not a secret anymore. So tell us about, how did you insulate him from competitors? Who are you in the trenches going against now? How's that going? Give us a little bit of background there, Lynn.
Okay. Well, when he sold the business originally, and even prior, he had a relationship and still does with one of the local banks, and the bank had made him an offer for. Of course, they had pitched some investments, but also they had made him an offer for like a special rate on his cash. And I honestly, he never shared with me what he negotiated with the bank, but apparently the folks here went to their corporate office and said, hey, we got a guy that's getting ready to sell a $20 million business. What can we do for him as far as our interest rates and stuff? So, but he's still got about $8 million at the bank, and literally was waiting until after tax time because he knew he was going to have to pay a pretty significant amount of capital gains. But the capital gains taxes did not turn out to be near as bad as he thought. So he's going to end up with still about $6 million. So my main competition at this point for the rest of that money would be the bank that it's sitting at. Very, very conservative. I don't know. I don't think that they've made investment recommendations that he's followed up on. But that would be the main competition at this point. And I think we just went last week to kind of a follow-up meeting or really initial. Probably going to end up having him do a family limited partnership to get the LLC out of his estate. I think that's where the attorney's going. We had a conversation with her last week, and so it remains to be seen what happens with the other $6 million that he's got sitting in cash or something at the bank.
Well, and this is a good point to probably just discuss, because I think anybody that's been involved with a business owner, especially you get to a liquidity event, banks are going to want to be involved. One, if they have a mortgage on the property, they're going to be intricately involved, I think, in the process, because they're going to want to know that mortgage is going to be retired. They're obviously, money probably was wired in this case. Linda, how did the money come in?
Yeah, it was wired directly to the bank, and then he literally, when he came to came and we're sitting talking about some investments, and he said, I think I'm going to give you a check here for $5 million. And I'm like, okay, that sounds good.
That's a good feeling to get those checks. So typically, yep. Here where we are, we run across a couple banks, BB&T being one of them. So, the local hierarchy gets involved, and they will try to want to impress upon people, we'll give you this really, really good rate for cash. So I think it's really good to have conversations with clients. Well, one, that feels safe. You're with a large bank, either like a Chase or a super regional like BB&T or even a local bank. But keep in mind, one, how much of that is safe. But two, once a customer gets to a certain size, they may want, and they might feel very impressed if the bank says, we've got a special deal for you. But if you go to the Thompson and kind of go to trading, fixed income trading, right here, the capital preservation model on our system is a great tool to use if you find yourself in a kind of competitive situation against the bank. Because ultimately, a bank's balance sheet is going to be probably 2/3 to 70-some-odd% in agencies and treasuries, and the difference in probably AA rated or better municipal debt. Banks can kind of name a little bit higher rate maybe because they're backing it with loans, but that is also a place to try to get in and get more of the deal with clients, because generally speaking, banks will try to play the "we are a bank" card, quote unquote, and you can hopefully compete pretty strongly with them. Another question, Lynn, for you is, and this is kind of where we're going. Edward wrote this. Is where do you think this goes? We talked family limited partnership. His questions were, what are your other goals for the relationship? What percentage of the wallet share, additional business? How aggressive are you being with him to try to get other dollars in?
Good question. And to your point about the banks, it is BB&T is the bank that we're competing with in this area. So in this case, what I would hope for for wallet share, I'd like to. I'm hoping to get another 3 or 4 million. I know that the client is going to keep quite a bit of cash because he always has. He's used to having quite a bit of cash at the bank, and so I feel fairly confident that will continue. But I would love to get another 3 or 4 million once we get a little bit more involved in the estate planning work that I'm sure the attorney's going to suggest. So one of the things that I think is going to happen is I believe she's going to encourage him to move that building that is in the LLC to a family limited partnership and start gifting shares of that partnership to the 3 children and maybe even to the grandchildren. I'm not sure about that, but so what I was considering legacy money where we didn't need to drive income with this $5 million that he put with us, we are now going to probably have to replace that income from the lease of the building. And again, that was about $20,000 a month. I'm fairly certain that he doesn't need that much income, but we will have to start driving some income for him in the future once once some of this estate planning stuff gets put into place. And I forget what the question.
Well, yeah, very good answer there. In this case, you've got a whale by anybody's estimation of a client. Walk us through the service schedule. How frequent are the touches? What type are the touches? What do you do for birthdays, anniversaries, that type of thing? Kind of walk us through your kind of service model with this gentleman.
Great question. I started with John at the beginning of this year. So we are incorporating the 1242 model. So I meet with him either by phone or in person once a month. We go through just questions, portfolio, talk about estate stuff. As far as any the things about birthdays and stuff like that, we don't have that system set up yet because again we just started with the D2 in January, so we're just trying to upgrade as many clients as we can to a new system, and so I don't have an answer for that yet.
So that's work in progress. Will help you give him some wow moments as we go along. What I've got pulled up here, Lynn, is Morningstar report. So tell us about, $3 million is in separately managed accounts that are a little bit kind of, I think, blended in general. Kind of tell us the selection process, how what type of reporting you get, what questions does the client ask in the meetings about it, how satisfied, how's everything work, that type of thing. Just give us some background on this.
Right. The wealth management group, Ken Spangler is the rep that is in our area, I guess, and they helped put together this, help pick out the select separate accounts, and it is more of a balanced portfolio. We've got some preferreds in there, some fixed income, some international, some large cap, small and mid, so a little bit of everything. Again, the thought process was that this was really legacy money that the client's not going to use, that we hope that we're going to be able to grow that, that pot of money and have that be available for the heirs, and hopefully it won't be all used for estate taxes. So when looking at as far as the portfolio reviews go, I get a report from the wealth management group. It's not a whole lot more sophisticated really than just a Morningstar, but as far as the performance, he's been pleased thus far. The total account is up over $200,000. So and he's like, well, it's going to go up and down, and just not. Now, he doesn't seem to be very concerned about what's doing well and what's not doing well. So he doesn't get a lot of questions. He's more interested, I think, in the North Carolina muni bonds and how those are doing, what the duration and maturities are. More interested certainly in what kind of, and it's been to going forward. I'm sure he's going to be more interested in what the income stream is going to be like out of that bond ladder.
Well, let me ask a question before we get to the bond, because sometimes people, other advisors on this call might be wondering, okay, so you have a gentleman, his blood, sweat, and tears has gone onto a business. And maybe once a year when he got his taxes done, maybe an accountant did a balance sheet for him and said, okay, this business is worth, 8, 10, $12 million. Now he gets the dreaded monthly statement. And you kind of alluded to it. He's been, and you told me on the kind of pre-work for the call, his demeanor was very lovable, like a granddad.
Right.
So all of a sudden you go from, and I'm sure he probably was wealthy and kept money in the bank, but now you're getting a statement saying I got $5 million. I guess walk me through, what was January like? Did he even comment in February, hey, I got my January statement? It looked like the month was, not one for the record books on the upside. Did he comment at all, or was he just very true to his word? He's focused long term.
Focused long term. He didn't say a word about, wow, it looks like my account's down. Anytime I talked to him about it, or when we were actually sitting in the conference room looking at the portfolio, he just kind of laughs. Says, "Yeah, that looks like that one's lost a little bit." And I'm like, "Yeah, that one's lost a little bit, and this one's gone up." So he's just not a real detailed. I've got to have, real specific. Here's your investment returns, et cetera, et cetera.
So as we look at cash flow, I'm scrolling up here. The yield didn't come through because they're SMAs, but let's go through to the muni bond ladder and kind of go through this. So we've got, roughly it's around $2 million, correct?
That's correct.
Okay. Looks like, we've got probably effective maturity of about 5 years. Did he have any input and preference to kind of help drive the decision on how the dollars were invested?
His main concern was he didn't want the maturities to be really long. He didn't want it to be out there because literally he's 85 and he's had leukemia, and he's like, I'm not going to live, 10, 15, 20 years, so I don't want those maturities to be that long. And I had to continue to remind him that, Mr. Client, you told me that this portfolio is really more about your kids and grandkids, so, just kind of reminding him that this is his legacy portfolio. But he was concerned about the maturities. He didn't want to, really long maturities, so we tried to keep those pretty short.
Okay, very, very good. Yeah, because we've got, yield to maturity about 1.25, yield to worst about 1.2. Did he have? The back office prepares reports like this. Was he really intricately involved in looking at them, or did he have any input on what type of debt to buy, what locations, school districts, places he was familiar with?
Nope, he didn't have any any parameters about any of those things. He, basically I went through here are the different types of agencies we've got, and obviously he's familiar with different counties and hospital authorities and things of that nature. So he was pretty comfortable with it, knowing that the other thing that was so attractive to him is that this is not gonna create tax issues for you. So he was very pleased about that.
Yeah, absolutely. I was looking at the previous slide, about $80,000 a year in estimated income. Tax equivalent, just real quickly back to napkin, he's probably 40% bracket. That's the equivalent of probably making about $133,000 a year. So that's a very, very good, income for him. Question, Lynn. Now, Wes Gersh from Louisville, he's writing in to see, in your meetings, are you meeting with any other family members, such as children, to, build a relationship in case something happens to the client's mental or physical capacity?
Yeah, his oldest daughter is involved in all of our meetings with the estate planning attorney, and I've I've held a couple of, one specific event. We have a minor league baseball team here in Charlotte, and so I had did a suite for his whole family last summer. So I've gotten to know the children. The son-in-laws were also involved in some of those golf tournaments that I played in with him. So I know the son-in-laws pretty well from playing golf with them. Now know the daughters pretty well, and have met all the grandchildren and even all the great-grandchildren. Been to his retirement party. So we've established some relationships with the children. I think we will get. My hope is that at least one of the three children will become clients. They've expressed interest in meeting with me. One of the children, the son is, I think, the oldest, or he might be in the middle. Does his own things, planning to move to Florida when he retires, and then the other daughter, again, I'm hoping to be able to get them in as potential clients as well.
Very, very good. And that's a great question. Great question, Wes. So, kind of looking through here, these type of reports, the bond desk can put them together for you. A lot of them are available really on the Thompson fixed income trading side as well. If you know the QSIPs, you can put in information. So overall, if we look at kind of the $2 million taken in consideration with the other portfolio, he's pretty fairly balanced. How often, within your 12-4-2 schedule, are you making investment changes when you meet with the client?
We have not made changes yet. Again, the portfolio just literally got put together towards the end of the year last year. So we haven't had it. We haven't had it more than, I'd say, about 6 months, 7 months. We do have. I think there's a bond that's been called already. So he's still holding some cash in the brokerage account. There's about $83,000 of cash in that brokerage account where the income's going from the the income from the bond. So the last meeting I had with him, I asked him, do you, knowing full well that he has $6 million at the bank, I'm like, do you want us to make some investment recommendations on this $85,000 that's sitting in your cash here? And he's like, no, let's just hang on to that. So so he's not in any hurry to get a lot of trading done in this account.
Edward Ness had a question about your selection for the bonds. Kind of go through a little bit of the rationale on why you chose brokerage as opposed to SPS on the bonds.
Lord, even with all the income, even with all the cash that the client has, he's pretty fee averse. I wouldn't say pretty fee averse, but he's questioning he's questioning the fee. So I didn't feel like using a managed account would be the right thing at the time. And then the wealth management group, the guys that put together the bond ladder for me, they weren't pressing to say, hey, you need to move this to an SPS account. So that's how that happened. And back to your point about the report that you're showing on the screen there, Drew, your assistant Grant showed me how to get on Thompson and actually print this report, and it's really, really easy. You don't have to. You don't have to load the QSIPs or anything. You just hit a button and it'll select all those positions, and then you can run that report. So that was very helpful.
Kudos to Grant. We'll give him a big pat on the back, and he's a keeper. We'll feed him tomorrow before we send him back to the galley to row well and live. Well, generally speaking, too, you get a case this size. I've always been a firm believer that pigs get fat and hogs get slaughtered. Your brokerage piece, the commission on these bonds are going to be built into the price. With this many bonds and the way that they're laddered out, I'll go to that next slide. What you're getting is also between 2016 and really you've got big years in 2020, 23, and 24, huge reinvestment opportunities. So, basically you probably looks like beginning at the end of 17, you've got about an 8-year run where you'll have, $200,000 a year to place back in some types of investment. So, very good work there.
Well, and assuming, assuming the client lives, I mean, he is 85, so, I hope and pray that he lives quite a long time. I'd love to see that man live at least to 100, but, it's entirely likely or that we'll end up splitting these portfolios to the kids.
A good selling point that I would get into, we do a tremendous amount of debt settlements here, even for other advisors we work with. Stacy's so good at it. But, to get some more money in, he's got 3 kids. If they're the primary beneficiaries, the best thing to do, a lot of times what we'll do is on an elderly client, go through the positions. And, if they have a $100,000 bond, hey, this is a great bond, this thing's going to be split 3 ways. Maybe we need another $50,000, so each of your kids just get a $50,000 piece of this. So, as we go and work, that's part of the work we do with our older clients to make sure it's going to be divisible because, at that age, you could probably concur, he's thinking about his legacy. He's not really probably even thinking that much about the $20,000 a month. And if that means moving another measly $400,000 or $500,000 out of the bank in the next meeting to make sure his kids are all dealt with evenly, that's typically, we found, a pretty good way to generate additional revenue, have money come in the door of the practice so you can help your clients meet their wishes. But that's just a
great point.
Yeah, old experienced trick there. Let's see if we have any more questions kind of coming in for Lynn. Oh, yeah, one question was, do you charge them in brokerage even fee averse? I'm guessing was the sale commission built into all these bond prices, Lynn?
That is correct. Mm-hmm.
Yeah. So just you disclose it to the client. I mean, the price has the commission built in, and we'll see that.
And the SMAs, I think we charged them 1% on the SMAs.
Okay. So, you go through the pricing. A client that's probably as accomplished a business person as he is looking at the bottom line, and that's probably how he was raised. He grew up through the Depression. I'm sure we find that, with our older clients, are always wanting to know what I'm making, and we definitely let them know that. Any other thing you think that would be, as we kind of close the call, Lynn, that you might feel like it's important to kind of share with everybody on where you were with this and kind of what your goals are for moving forward next?
My main goal at this point is to keep working with the estate planning attorney, and because, like I said, his current estate documents are very simple. There's just not a lot of tax savings strategies in there at this point. So I'm anxious to get that started and get him engaged in that and get that going, because I just know if God calls him home at the wrong time, we're still going to have some major issues. So that's kind of the focus at this point.
Okay, that's excellent, and we wish you the best of luck. We'd love to have a follow-up for the next 8 meeting. I think we have another question that's come in. I failed to realize that Edward Ness is Fast Eddie, Poach. What do you feel the biggest opportunities here? So I guess if you were going to look at in the here and now, let's call it here and now, the rest of 2016, Lynn, and the future after 2016, where would you see the opportunities now and then for the future?
Certainly now the opportunity is trying to get him to move some more of that cash that he's got sitting at BB&T. That I think that's going to be I'm not in a hurry about that, just because I don't want to push him, and maybe that's not the right attitude, but that's his style. He's not like a hard driving, let's go, let's get this all done. It's more of a let's drip, and I really like your idea, Drew, about as we start to position these things, let's make it so that when we have to divide it up by 3, that it's going to be easy to do, and we're not dealing with a bunch of partial shares or this, that, and the other thing. So great idea there to try to help me, attract more of the assets, get more of the assets over here, and that'll be the short-term thing. Besides, again, working with the attorney to try to get his estate documents upgraded a little bit. Long-term, I'd love to have all the money. I'd love to have 2 of the 3 kids as clients, and again, we're working on that, and that's kind of the long-term view.
Have you, this is a question now, and because I think people might be thinking it, there's a lot of long-tenured advisors on the call. You've been in the game 22 years. Typically, a family, you got 3 kids, you have 2 that probably are normal, well-adjusted, just statistically one's not going to be. Have you gone through and had those conversations yet, or how have you, if you have, how did you do your due diligence to say, you know what, I'm picking up on this because you said I'd like to have maybe 2 of the 3 children. It's something we all face. There's just usually maybe in your case an extra comma and maybe some zeros here. How did you ferret that out, or how are you going about doing the due diligence? That
third child works in the business, but between the comments that I've heard about him over the years, and I mean, for the last 5 or 6 years that I've known all of the people in the family and what their roles are in the business, I've picked up on the fact that he is not he's just not he's not socially adept. So very much a loner, wants to do his own thing. The family, they think that he's working with a financial advisor already. So literally, he still lives in his dad's house. So that's just one of those. I don't think we are going to want to try to attract that guy as our client.
Well, we've done some D2 videos about living in the basement of your parents' house. And that's kind of the, I'll leave it at that, but it reminds me of a guy named Keystone Life. So, Lynn, we want to thank you for being on the call, and I appreciate everybody kind of bearing with me. I'm not used to being the tech moderator. You put me on a microphone in a tuxedo, with the Rat Pack, I'm at my best, but sometimes behind the camera here with all the tech stuff, I'm not. But when's our next webinar, JJ?
We're actually taking a break until August. We are off for the summer to let everybody kind of enjoy their little summer break. So we'll be back in August.
I recommend Nantucket or the Vineyard to anyone who wants to go vacation with the Obamas. Other than that, I'll be on the Ohio River, dodging corpses and floating debris for my summer vacation. Everybody, let's have a wonderful summer. We're here to help any way we can. Just send emails to Jacqueline. She'll give them to me, or I think everybody on the call knows Grant. And everybody have a wonderful summer break. Thank you very much.